Today, we're diving into the backbone of finance that most investors overlook, corporate bonds. We're talking about debt securities that have quietly powered portfolios for decades, delivering steady returns while everyone else chases the next hot investment. Intrigued? You should be. In 2024, investment-grade corporate bonds delivered solid returns of around 5.6%, while high-yield bonds soared with an impressive 8% total return, all while maintaining relative stability compared to volatile equity markets. To put that in perspective, these bonds consistently outperform many traditional investments while offering predictable income streams. But here's the kicker. Corporate bonds aren't just about steady yields. They're about understanding how companies finance their growth and navigate economic cycles. So how can something seemingly boring generate such compelling returns? Stick around, because we're about to unpack how corporate bonds work, who issues them, and what made 2024 such an exceptional year for bond investors. Let's start with the basics. A corporate bond is essentially an IOU from a company to investors. You lend capital to the corporation, receive regular interest payments called coupons, and get your principal back at maturity unless the company defaults. It's like being a bank to businesses. Think of it as the opposite of buying stocks. Instead of owning a piece of the company, you're lending it money and getting paid interest for the privilege. Imagine a 5-year bond issued by a major technology company. Every year you earn your contractual interest rate, say 5.5%, plus you get all your money back when the bond matures. But if that company hits severe financial trouble and can't meet its debt obligations, you could lose part or all of your investment. That's the trade-off. Higher yields than government bonds in exchange for credit risk. The corporate bond universe spans from rock-solid investment-grade issuers to riskier high-yield companies. Investment-grade bonds, those rated BBB or higher by agencies like Standard & Poor's, typically offer yields between 4 to 6%. High-yield or junk bonds from companies with lower credit ratings can offer 7 to 10% or more, but with significantly higher default risk. Why do companies issue these bonds instead of going to banks? Scale and efficiency. When Apple needs $10 billion for expansion, it's far easier to tap the bond market than negotiate with hundreds of banks. Corporate bond markets provide massive liquidity. The global market reached an estimated $19 trillion in 2025, with US investment-grade issuance alone hitting $1.5 trillion in 2024. So why invest in corporate bonds? 3 key reasons: predictable income, diversification benefits, and risk management. Unlike stocks that may or may not pay dividends, bonds provide contractual interest payments. Corporate bonds also behave differently from equities during market stress. When stocks crater, investors often flee to quality bonds, providing portfolio stability. The bond market isn't for passive buy and hold investors alone. Sophisticated institutional managers actively trade based on credit analysis, interest rate expectations, and economic cycles. They hire teams of credit analysts, economists, and sector specialists, much like equity fund managers, but focused on a company's ability to service debt rather than grow earnings. Picture this scenario. Economic data suggests the Federal Reserve might cut interest rates. Bond prices typically rise when rates fall, so active managers might extend duration exposure to capture capital gains. Conversely, if credit spreads look too tight, meaning investors aren't being adequately compensated for risk, managers might rotate from high yield to investment-grade bonds. Let's examine what made 2024 exceptional for corporate bond investors. Investment-grade bonds delivered a 2.13% total return, with spreads tightening to historical lows around 80 basis points. This spread compression, the difference between corporate bond yields and comparable treasury yields, reflected strong investor confidence in corporate credit quality. High-yield bonds significantly outperformed, posting an 8.119% return. The trailing 12-month default rate ended 2024 at just 1.5%, well below the historical average of 4%. This combination of low defaults and tight spreads created ideal conditions for credit investors. However, 2024 also revealed cracks beneath the surface. Default rates in leveraged loans reached 5.26%, higher than 2020's pandemic levels. Repeat defaults, companies defaulting multiple times, hit record levels at 35% of total defaults. This suggests that while higher quality credits remain stable, the riskier segments of the market face significant stress. Who issues corporate bonds? The spectrum ranges from blue-chip multinationals to emerging growth companies. Financial institutions represent 53% of the global corporate bond market, issuing debt to meet regulatory capital requirements and fund lending operations. Banks like JP Morgan Chase and Goldman Sachs are among the largest issuers and also serve as underwriters for other companies' bond offerings. Industrial companies comprise another major segment, issuing bonds to fund capital expenditures, acquisitions, and working capital needs. Technology firms have become increasingly active issuers, taking advantage of low interest rates to fund research and development, share buybacks, and strategic investments. Utilities represent a growing segment, accounting for 21% of net additions to the US investment grade index in 2024. The risk-return mathematics make corporate bonds compelling. Historical data shows corporate bonds have delivered average annual returns of 6 to 7% over long periods. This exceeds government bond returns by 1 to 2% annually, a substantial premium that compounds significantly over time. Credit rating agencies play a crucial gatekeeping role. Moody's, Standard & Poor's, and Fitch analyze companies' financial health and assign ratings from AAA, highest quality, down to D, default. These ratings directly impact borrowing costs. A one-notch downgrade can increase funding costs by 10-20 basis points or more. Looking forward, several trends are reshaping corporate bond markets. Environmental, social, and governance (ESG) considerations increasingly influence investment decisions. Green bonds and sustainability-linked bonds represent growing segments, allowing investors to align investments with values while generating returns. The corporate bond market exemplifies finance at its best, efficiently allocating capital from savers to businesses that create jobs, products, and economic growth. When you buy a corporate bond, you're not just investing, you're providing the funding that allows companies to expand, innovate, and compete. To wrap up, corporate bonds transform business financing needs into investable opportunities, rewarding those willing to analyze credit risk for steady, predictable returns that have historically outpaced government bonds and inflation. They showcase how financial markets efficiently allocate capital while providing investors with diversification benefits that no single asset class can offer alone. What do you think? Would you consider adding corporate bonds to your investment portfolio? Let us know in the comments. And if you enjoyed this deep dive, give us a thumbs up, subscribe, and hit that bell icon. We've got plenty more content on fixed income strategies, credit analysis, and the evolving world of finance. Thanks for watching, and until next time, stay informed and stay diversified.